In many ways, investing in the stock market can feel a lot like gambling in a casino. With more than 6,000 different securities listed on US stock exchanges, investors have the freedom to basically buy shares of whatever they want with the hopes of eventually selling their investment at a higher price than what they paid for. For the investor who doesn't know what to look for, it can feel a lot like playing the roulette wheel inside any gambling hall. Picking random ticker symbols for your investment portfolio is really no different than someone placing a bet on a random number, hoping that what they've picked will ultimately lead to a profit later on down the road. This is how the majority of people tend to view the stock market. According to a 2019 survey conducted by LendingTree, they asked 1,000 Americans what their belief was about investing in stocks, and they found that roughly 55% of Americans view the stock market as being equally as risky as gambling in a casino. 1 in 4 respondents think that the odds of making money in the stock market are the exact same odds as making money from gambling, and approximately 1 in 5 respondents in this survey also claim to have an investment account that they're keeping hidden from a spouse or a partner. With these results in mind, it's pretty clear that many people don't seem to have a healthy view of the stock market. And all of this is completely reasonable, because we hear in the mainstream news stories of corporate scandals like Enron and WorldCom where investors who owned shares of these companies lost everything. We've also seen the rise of Wall Street bets, which are a group of mostly younger investors who come together online and attempt to pump certain stocks in the hopes of making large, quick gains in the market. Out of this movement, we've heard stories of people making huge gains overnight, as well as people who have lost their entire life savings on these speculative stocks. It's really unfortunate that these are the kinds of stories that the major news networks like to report on, which only makes the perception that the stock market is basically one big gaming hall only worse. Probably most of us still clearly remember the 2008 financial crisis, where at one point the S&P 500 had lost about half of its value. Countless documentaries were made on this event. Most tragically of all were the stories of countless retirees who lost most of their savings, 401ks, and IRA investments during the event. This caused many retirees to take drastic measures, from coming out of retirement and returning to the labor force to having to downsize their lifestyles in order to pay their bills. These events only reiterated the belief that investing is a highly risky activity. And while it is true that all investments do carry some amount of risk, the fact is that the stock market as a whole has always climbed upward over the decades. What you're looking at is the historical share price performance of the S&P 500 index over the last century. You can see periods where the market did experience sizable drops, like the market crash of 1929 and the 2008 financial crisis. But it's important to take note that over time, the market has always marched upwards. It's always become bigger and bigger as time goes on. Even though there have been plenty of blips and periods of flatlining share price performance, the market still has and continues to grow larger and larger. And I know that the S&P 500 hasn't been around since 1872, but this chart still represents some of the top 500 largest company stocks in the market at that time. It's also true that the stock market is responsible for making more millionaires than any other institution or investing strategy out there. More than investing in real estate, or crypto, or NFTs, or fine art, or cars, or the horse track, cockfights, or investing in antique collectible spoons. So with this in mind, it's clear that investors can and do make money in the markets. But I personally think the biggest problem that makes investors skeptical about the stock market is how volatile stock prices tend to be. As of the making of this video, the markets have been experiencing some very high volatility this year, which has understandably been making some investors feel pretty sick. Watching share prices go up and down tends to make people pretty nervous. Even people who claim to be long-term buy and hold investors often get so nervous that they will sell out of stocks when we experience a really bad day. But every investor needs to know what exactly it means to buy shares of a company's stock. Owning shares of a company like Realty Income or McDonald's or the Home Depot is the equivalent of being a partial owner of a company. When you buy shares of a stock, you're basically the owner of a minuscule part of the company. This is how equity offerings work, and when you understand this, it'll significantly impact how you invest in stocks in the stock market. You need to view yourself as being more than just an investor, but a partial owner of the company you're buying. I can tell you the number one way people lose money in the stock market is because they don't know what they're investing in. They buy shares of a stock simply because the price has been going up the last few days or weeks and they hope it'll keep going up. Or they buy shares of a stock simply because someone on CNBC or some internet blog was promoting it and they don't ever do any due diligence or research into what they're buying. This isn't investing, this is called speculation, and more often than not, it results in sizable losses for investors. This kind of investing actually is much more like gambling rather than buying quality stocks. Take a stock like Coinbase, ticker symbol COIN, as an example. This is a really popular stock that I see people talk about all the time on CNBC, Reddit, and a lot of people here on YouTube talk about how great of a company it is and how investing in it could make you a lot of money in the future. But what exactly is this company, and can you actually describe how this company makes money? If you can't, then you shouldn't be investing in it. I guarantee if you actually did some research into this stock and looked at their financial statements, you'd probably want to stay clear away from it. Because despite all this hype, this company's been reporting massive losses this year. Since this stock's IPO, the share price has collapsed by more than 75%. Now, could this potentially be a good investment later on in the future? Sure, absolutely, but it's still a very, very long ways away from that. For me personally though, when it comes to investing, I prioritize stocks and funds that offer dividends, and I prioritize dividend payments over stock price performance. I don't care how much the share price of my favorite dividend stocks move on a daily basis. I only care about my stock's ability to consistently pay me the exact same or growing dividend distributions every month or every quarter. As you can imagine, this gives me a lot of peace of mind. In fact, red days are even my favorite days because it means I can buy stocks at a cheaper price and collect the exact same amount in dividends that they pay. A dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or surplus, then some stocks pay dividends to their shareholders. Some stocks have even offered dividends for over a century, lasting through wars, recessions, the market crash of '29, and the financial crisis. Some companies like real estate investment trusts and business development companies are required by law to pay out 90% of their earnings to shareholders in the form of dividends. Not every stock pays dividends, but I only invest in stocks and funds that pay generous dividends. It's an investing style that's not for everybody, and I completely understand that, but I would like to say that if you struggle with the motivation to invest, or you feel beaten up after buying all of these aggressive dividend growth stocks that didn't work out, then I'd suggest giving dividend and income investing a try. I honestly find it extremely addicting to invest for dividends over share price growth. The largest holding in my stock portfolio is Realty Income, which is a monthly paying dividend stock. Every month I receive $103.62 from this stock, and I'm extremely motivated to invest more and more so I can build up that monthly dividend that I get. This company hasn't cut their dividend in their 28-year history being a publicly listed company, and they've increased their dividend 116 times. For people who invest in growth stocks and ETFs and rely on share price gains, you've no doubt been sweating this year. A lot of popular growth stocks like Coinbase, Roblox, Netflix, and Meta are down significantly this year. Some of these stocks are down by over 50% since the beginning of this year. At some point, you'll have to try to figure out when it's time to get out of a growth stock after you've determined that it's done growing. You then have to move your money into a different holding that hopefully won't be a dud like Voyager Digital was. This was a very popular stock that all these YouTubers promoted, and it recently went to zero, resulting in investors losing everything. But if you're nervous about investing in individual stocks and you don't want to try it for yourself, then my suggestion to you would be to invest in an index fund ETF. It's a diversified investment that seeks to track the returns of a market index, and they have them for the S&P 500, the Russell 2000, the Nasdaq, and so on. Companies like Vanguard and Charles Schwab offer a lot of different options for you to choose from that charge very low fees. For dividend investors like myself, my favorite ETF is the Charles Schwab Dividend Equity ETF, ticker symbol SCHD. This ETF tracks the performance of the Dow Jones US Dividend 100 Index, which holds a collection of some of the highest yielding stocks in the Dow Jones that have consistently offered dividend growth. If we look at this ETF's performance, we can see situations where the share price dipped or flattened for a period of time, but when we look at the dividends this ETF has paid, we can see that it's continued to grow over the years, which is what I really like. This is again why I really love red days in the market. When the price of SCHD goes down, then that's when I like to buy. But if you do decide to invest in individual stocks like I mostly do, it helps to educate yourself on how to read financial statements. One of the most important things that you need to do when researching a company is to have an understanding of how they make money in the first place. To summarize, even though the market has been falling a lot this week, you shouldn't feel like stocks are the equivalent of gambling. More people tend to hold this opinion during bear markets or whenever we have a really sizable loss across the market. But remember what we covered, the markets always grow to become bigger and better as time goes on. The stock market makes more millionaires than any other institution, and you can significantly reduce, but not completely eliminate, the amount of risk that you're exposed to by diversifying your investment portfolio and understanding what it is you're investing in. It can be really tempting to sell everything in your stock portfolio and wait until you think that the market is done falling. But remember, nobody can perfectly time the market. We don't know what tomorrow is going to bring. Will it get worse, or will the recovery begin tomorrow? Nobody knows for certain. So unless you're invested in a really crappy company or you want to save on your taxes, just hold on until we're done with this bear market that we're going through. You really want to make sure that you don't miss out on the recovery whenever it starts.